Good morning, real estate mindset community. Happy Friday. I'm absolutely humbled and blessed to be able to spend the end of the week together with you. And don't forget, you guys, we're also going to start next week together. I'm doing the lives now, morning lives, 8:45 Central Time, Monday and Friday. I want to be able to end the week and start the week with you. So I'm really excited about today. I have a whole bunch of data to go over with y'all today, whole bunch of data. Everything will be chaptered in the description. Really excited about today. Real quick, let me just give a shout out to everyone that has joined us this morning. Night Cree, appreciate you. Ray, everyone, appreciate you. Steven, the Robert Show, FBB, Florida Beach Bum, I want to be more like you. There's Christy. Where's Trey? There's Trey. There's Dean. Where's Jeff at? Where's Jeff? Where's Johnny? There's Vovol. Good morning. There's Dean, Steven. Appreciate you guys. I am blessed. I love you guys so much. So we're going to get jumped in. Oh, there's Les. What's up, Les? Hope you're doing well, man. I am fighting for you, Les. I don't know how you got in my head, man, but I think about you all the time. I actually gauge you as a consumer. So I'm like, all right, this many consumers think like Les. So I appreciate you, man. Keep on talking. There's my man right there. What's up, Johnny? What's up? What's up? What's up, Trey? This is my dude right here. I love Trey. This guy has the biggest heart. He's responsible for setting up the Discord group. You guys join the Discord group. Got some pretty cool conversations going on the community. So we're going to start this immediately by jumping into the mortgage rate update first. So let's go ahead and switch screens now. And I'm going to start off pretty easy with this report, you guys, just so everyone's on the same page. And again, we're going to cover so much information today, but here's our mortgage rate report. So the first thing is I just wanted to remind everyone that doesn't know already that mortgage rates do not follow and track the federal funds rate or the interest rates that Jerome Powell is cutting or raising, the federal funds rate. That's not, although it does influence the mortgage rates, that's not tracking it. If you guys want to track residential mortgage rates, you got to look at the 10-year. And I just wanted to show you guys the spread, the spread in the 30-year fixed rate mortgage and the 10-year treasury. You guys can see it doesn't track it perfectly, but it certainly tracks it well. So if you want to know what's going on, stay looking at the 10-year treasury. Now let's look at the market today as far as the 10-year treasury. Pretty interesting stuff going on, you guys. So we're sitting at right now. Now, this is the economy crusher, right? So this is economy crusher. We're sitting at almost 4.17. Now, I wanted to remind you guys, we started the week at 4.07. So week over week, or at least Monday to right now, it's up about 10 basis points. So keep your eyes on this. This is going to impact residential mortgage rates. Now, take a look at the 2-year. 2-year, pretty interesting. It's actually up today as well. So the 10-year's up slightly today. The 2-year's up slightly today as well. This is the inversion we look for. Now, the 2-year's actually at a high close to December of 2023. So about a 2-month high on the 2-year. Very interesting. But week over week from the start of Monday, it's actually up 6 basis points. So from Monday to today, both of those are up. Let's take a look at that residential mortgage rates. Right now, you guys, we're sitting at very, very close to 7%. So more than likely what's going to happen is I suspect that this is going to go up at the end of today when it reports. Now, remember on Monday, I said that, it's going to update its report and interest rates are going to be sitting in the 7s. That's exactly what happened when I ended the live. Interest rates did update. It went to 7.04. But what's interesting is even though that 10-year is up, and that's why it's not perfectly tracking, but it's tracking it very well. So even though the 10-year is up, the 30-year fixed rate mortgage is down. Very interesting, right? So just pay attention to those things. Again, more than likely at the end of today, we're probably going to hit 7% again. Keep your eyes on that. Again, that is Mortgage News Daily. Pretty good source of information if you guys want to stay on top of the mortgage rates. So let's move on. I want to show you guys this real quick. This is very interesting. This is basically giving us the update on the golden handcuff effect versus the handcuff effect of homeownership. And what this is saying is basically where people are purchasing at or what people are getting their mortgage at as far as interest rate. So you guys can see that it really, as far as that golden handcuff or interest rates, say under 5%, that really stopped happening. What would you say, half the middle part of 2022? So now fast forward to today, you guys can see the blue lines are 2023. So I'm saying that because remember right now, although there is the golden handcuff effect, which means people aren't selling because of the low interest rates, right? there's now an overwhelming amount of home buyers that are just handcuffed to their house because they're getting interest rates up to 8.8%. This goes actually, I think, to 9%. So there are people getting 9% right now. But I want to remind you guys again, those recent buyers are in the biggest risk. They're at the biggest risk because, again, they don't have the ability to refinance or sell. More than likely, they have the higher interest rates. They have no equity. Unaffordability is probably ravaging a lot of them. We see that in cash out refinances. But you guys, it's changing. That box of handcuffed homeowners is dwindling. It's still a lot, but I'm saying it's dwindling, and it's being replaced by 6, 7, and 8% interest rates. So I thought this was a good chart to show you guys on what's happening on that front. Now take a look at the market's expectations of interest rates, you guys. So what's up, Cameron? I see you, Cameron. I see you guys. So here's the market's expectations of what's going to happen with interest rates. This is very interesting. They have completely kind of reversed what they were anticipating. This is great news because I'm going to show you here in a minute that we want to pay attention to spring home buying season, and that's just right around the corner. So I'll get to that in a minute. But here's the March report. They're basically saying more than likely they're not cutting rates in March. Thank goodness. We do not want them, in my opinion, to cut rates in March. That will probably, depending on the amount of cuts, that's going to mess with people's head. It will probably cause inflation. We don't really want rate cuts until some type of turmoil or economic hardship or credit tightening event happens. Because remember, we still have a lot of buyers on the sideline, but this is good. So essentially no rate cut in March, again, unless something falls apart. Take a look at May. The May is very interesting as well. This has actually changed this morning. This was not like that a little bit ago, but this is saying that this is pretty cool, actually. So this changed a lot this morning. So as of May, this is May report now, the market is saying 41% chance we stay elevated. That is a huge, huge difference. I've been trying to celebrate, okay, let's stay higher for longer. Let's stay higher for longer. We need it. But the market's saying it's almost, not quite, but it's almost about 50-50 for May. Intriguing, guys. But take a look at June. Let's see if this has changed. That changed a little bit. So June, it's saying rate cut, right? We're going to have rate cuts in June. There's about, according to the market, 94% likelihood that that first rate cut is in June. So about 50%, they're saying May, about, again, about 94%, I would say, for June. Take a look at July. So July, 1.3% chance. Okay, so they're saying 1.3% chance. Now, if we go to December and we look at like, what is the market anticipating as far as the entire year of rate cuts? And right now, you guys, they're pricing in about 100 to 125 basis points in rate cuts, which would represent 4 to 5 quarter basis point rate cuts. Okay, again, this is the market saying that. That is CME Fed Watch. Now, a couple of things that I want to go over with you guys as far as mortgage. First of all, if you guys are out shopping or you're on the sideline just checking things out and you want to get a payment, obviously work with the loan officer. Loan officer's primary job is to do due diligence and to get you numbers, right? To play with the numbers, put property taxes in, put homeowners insurance in, and give you info. But if you don't do that, here's a good way to calculate your payment, okay? Just type in mortgage payment calculator on Google, and this comes up right here. Now, remember, you guys, if you want to calculate an accurate payment, you have to click this button here, and you have to put in taxes and insurance, and it will automatically calculate your PMI or MIP, depending on if it's FHA or FHA or conventional. Okay, so again, you want payments, come here. You can play with this, home price, down payment, FICO score. But the thing that I like about this, again, is it allows you to put in property taxes and homeowners insurance. Now, going on over to the amortization schedule, by now, for you that have been watching me, you should know how bad mortgage debt can actually be and how that amortization schedule works. It works against you. That's why if you really want to get ahead, you have to break the amortization schedule. And an amortization schedule is how mortgages work, for the sake of argument. So mortgages are paid off by an amortization schedule and you making payments into that schedule. Okay. So remember, the first year of payments, you pay $22,000. Okay, first of all, let me show you how I set this up. This is a $324,000 loan. Your principal and interest payments about $2,149. That's why I showed you guys this over here, because that's just calculating PIF I, which is principal and interest. You want to do taxes, insurance right here. But going back over here, look at guys, $324,000 loan. Today's interest rate, you pay back $449,000 in interest. So your real interest rate is more like 125% or 130% if you want to be realistic. But total payments, $773,000. Think about what I'm saying. You purchase a house, you get a loan for $324,000. That true cost is $773,000 plus your down payment. Now let's just go here real quick, guys. I'm going to keep this one short. I want to show you the power of making extra payments towards your principal. You got to be very careful as well. Some servicers or lenders will take the extra payment and just put it in your escrow account. So a lot of times you have to specify, and sometimes it's easy, but a lot of times you have to specify that I want my extra payments to go to principal again, or they will dupe you and put it in your escrow account. But let's just say monthly extra payment, let's just say what, let's say $250, okay? So let's see what happens if you guys pay $250 extra per month towards your principal. Okay, let me calculate this real quick. So if you do that, again, $250 extra a month, you've now turned your loan into a 22-year loan. So you have shaved off a significant, almost a decade, not a decade, but almost a decade off your loan by paying only $250. And by only paying $250 a month, not only do you save that much time, you save $138,000 in interest. But remember, you guys, all of this changes if what? If you refinance. Remember that. So a lot of times what I would prefer as a loan officer, what I prefer to see people do is if they are going to refinance, say they want a lower rate and lower term, reduce your amortization, right? Reduce it. Say if you have a 30-year loan, do a refinance into a 20-year loan. But if you don't want to do that, again, you cannot be trapped into the higher payment. You can make your extra payments and still pay the loan off early. And that's really what I was trying to show you guys right there. So again, remember, you don't have to lock yourself into a 15-year or a 20-year loan. I'm sorry, my focus is messed up. You don't have to lock yourself into the higher payment. You can still get a 30-year loan, make extra payments to principal, and you have the flexibility to continue to do your lower 30-year payment. So just wanted to give you guys a heads up on that. But don't disregard how expensive a mortgage actually is. Realtors don't really talk about that. I wish they did. They say, again, marry the house, date the rate, but they're not going into the actual, what does it mean to date the rate? How expensive is it really to refinance? It's super expensive. So remember what I just showed you, you refinance, that all changes. So don't just refinance is the point I'm trying to make. Now, we're going to go into our first video, you guys. Oh, and another point I wanted to make here is, very, very important. I have like I said, our last live, I have a client right now that I'm helping, and I had them shop a direct lender and a broker. Remember, if you're out there purchasing real estate, shop your lender. You can save thousands, if not tens of thousands, maybe even hundreds of thousands of dollars by shopping your mortgage company. And I'm going to tell you right now, usually when it only comes to interest rate and you have great credit, the brokers are going to win. Usually the brokers are going to win, and they're going to win significantly as far as a lower interest rate. And remember, you guys, how interest rates work. I showed you on my last live. Remember the pricing. And also, you guys, one thing. On Monday, I'm going to do another market analysis. So on Mondays, we'll do market analysis. I'll probably do another example of pricing. But that's how mortgage rates work. You look at the actual pricing. Like, how much does the interest rate cost? So I hope you guys remember that. We're going to move on now, guys, to our first video. I'm going to do a quick timestamp. I feel like I'm talking too much. So we're going to do our first video that's going to go into basically the Federal Reserve is not in a hurry to lower interest rates. He's going to go into what is the bond market telling us. And I'm going to ask you guys this right now. Think about it. Why would the Federal Reserve cut rates right now? And also, I have a question for you. So not only why would they cut now, please comment below, but do you guys think that rates will continue to get higher in 2024? I'm anxious to hear from you. I'm going to play this video real quick, guys, but do me a favor. Let me know that the audio, hold on one second. I'm so sorry. But let me know that the audio is okay. And we're going to get started right now. But I am anxious to hear what y'all have to say. Let me know the audio is okay, please. Here's our first video.
To Ari Wald, head of technical analysis at Oppenheimer. Ari, you think rates are finding a floor here? Tell us what you see the bond market telling us.
Sure. Yeah, I think rates are finding a floor, and I think that's going to be the action going forward. The stability in the bond market that really should support equity prices looking ahead against this not too hot, not too cold backdrop. I think generally, not being an economist, I don't think the Fed is in a hurry to cut interest rates for the very reason that
Seems not. Yeah.
Yeah, they want to avoid that 1970 scenario, which when they did cut too quickly. So I think the market is rallying and with those expectations, and I think that's historically consistent. And be careful what you ask for. I think by the time they actually do cut rates, we could be closer to that market top.
Let's talk about your view is that the S&P is undervalued below 5,400. We're basically at 5,000 now, 49.90. Where do you think the S&P heads from here?
Up. We like that 5,400 level there by year end. So yeah, round number 5,000. I think we achieved 5,000 in a very bullish manner. The index's weekly RSI has reached a level of 73 that often discussed as being
What is RSI
overbought.
for those who don't know? Like
It's
me?
a measure of the speed of price. Now, a lot of commentators come here to talk about it being overbought. It's really just indicating that price is accelerating. We found that only 35% of major chops have occurred with an RSI above 70. That number drops to 4% when you're above 75. So the higher the RSI, the less likely we get a market top. Year two of the bull market underway. 70% of cycles have reached the 2-year anniversary. That's why we think it continues through year end. 5,400 would be on par with typical year two
historic gains in a second year of a bull market. Why don't we move on to a couple of individual stocks that I know you want to share your views on, beginning with Take-Two out after the bell.
The key with Take-Two is really the leadership that we've seen in the growth factor overall. It's been a broad-based theme. It's large cap growth, mid cap growth, small cap growth. And Take-Two, what's notable about the chart, it is one of the broadening list of stocks that continue to move higher above the December high. A lot has been made about moderating market breadth. Take-Two has bucked that trend. It's continued to push higher. It continues to show relative strength. It continues to retrace the stark losses suffered between 2021 and 2022, and we think that continues over the coming months.
Affirm is your next on your list. This has been a very hot stock.
It's been hot. The whole industry's been hot.
The whole industry's been hot. Do you think it stays that way?
Yeah, I like those broad-based themes. FinTech overall. Here's a stock that
more
really
than doubling in the past 3 months.
It really surged in the fourth quarter, and what it did, it moved above its peak level from August of 2022. It's been consolidating and working off those excesses by going sideways above that breakout. Very often former resistance becomes support, and we think that larger breakout continues looking ahead.
Let's move on to First Energy and get your thoughts there. What are the headwinds there? So you got to buy on Affirm, by the way. So
buy the growth names, Take-Two and Affirm, and sell defensives. We are bearish on defensive sectors here. I think it really represents utilities, counter-cyclical, defensive overall. All these stocks in the sector look like that. Multi-year relative lows, First Energy failing at its bearish 200-day average. We see that as a potential resumption of the stock's ongoing downtrend.
And it is HB6 scandal. Explain what that is.
All right, guys, I'm going to end it right there because it's kind of going into the stock market. I really just wanted to focus on the bond market. But again, comment below. I'm interested to hear what you guys think. Do you guys think the 10 years is going to keep going up? Or do you think it's going to keep going down because the market's aware that the Federal Reserve is about to rate cut? Because remember, you guys, interest rates have gone down roughly about 100 basis points without the Fed moving the federal funds rate. Think about what I'm saying. So the market's always trying to figure out what the Fed's going to do to try to get ahead of it. And they keep messing that up. And I'm going to show you that here in a minute. I'm really excited about this next portion, you guys. We're going to go into do our real estate update. But again, I want you guys to comment below. Let me know what you think personally is going to happen with the 10-year. Again, some people think it's going to keep going down. Personally, I think it's going to go up. And I've said that pretty much this entire time. I think it's going to continue to go up this year. And hopefully by the end of this year, it will go down and go down significantly because that's when the recession happens potentially, okay? So let's move on to the real estate update. I got so much for you in this update. I hope you guys are going to love this. All right, let me get it set up real quick. We're going to start with some interesting stuff. So I have a theory. I want to know what you guys think about this theory, if you will, okay? So what we're looking at right here so far, let me put up my notes real quick. I have a special notes. Okay, so this is the median sales price for houses sold in the United States. And I want to point us to the GFC. Okay. First of all, the GFC is right here. I think it's also interesting if we look at the GFC, the equity run up was from Q3, roughly from Q3 of 2022 all the way to Q1 of 2007. That is a 5-year run up in equity right here. I mean, my gosh, guys, this was a little over 2 years, about 2.5 years. So half the time for a bigger bubble. And I've heard people say, "Oh, we're on the down. We're on the down." I mean, look, where's the rebound, right? Where's the rebound so far? There is a rebound for sure, but like, where's the great rebound? And there was a pretty great rebound in some markets. I'll show you that in a minute. But here's what I want to really explore, and I really want you guys to think about this. First of all, I don't know how well you can see it, but y'all see this gray, what we want to call this column right here? This is when we actually entered recession. So I've been thinking a lot about this. Now, here's the interesting thing, okay? We had declining home values. Listen to me. This is GFC. We had declining home values for 1 year before we entered recession. So it's fair to say, okay, everyone's like, oh, the reason for recession, the reason for the GFC was subprime, subprime, subprime. And I'm like, well, actually, conforming had just a higher default rate and even more foreclosures actually than subprime. And I was like, also, well, it's also because they stopped paying. But what if people stopped paying because they no longer had value in their house and they gave up? What if right now, and I'm pretty safe to assume this, the reason we're not in recession is because of home values rebounding overall, I'm going to show you markets that they didn't, don't worry. But what if we are avoiding recession because they are propping up home values? Think about what I'm saying. I mean, this is really astonishing. So it's just really interesting comparing home value to recession. But again, I just want to make a point. Home values went down for 1 year before entering the GFC recession. They went down an additional year in that recession, and then it rebounded after about 3 years. So this was a long, drawn out process. Now, also, let's move on to the next thing. I hope you guys understand what I'm saying. Oh, and also real quick, I want to explain, a lot of people are getting lost in the crash narrative. I'm speaking about a price crash. I think an overall crash, you have to have systemic failure like foreclosure, but I've been talking about prices crashing this whole time, right? You guys, we have some metro areas that are down 15%. And the thing is people are like, no, there's no crash because they can't feel it. That's how much equity went up, you guys. Equity went up so much, 15% is nothing. That's insane. Look at the run up. Look at this run up. It went up so much so quickly, 15% doesn't even matter. But I want to tell you guys, okay, if you want to know how much on average median home value went down during the GFC, it's from Q1 2007 to Q1 of 2009, and that dropped 19%. And that's why, you guys, I have my definition sitting at 15% because I don't necessarily think we have to go into a GFC to have prices crash. I'm talking about prices now, okay? I'm talking about prices this whole time. We have a 19%. This is quarterly, by the way. So if we look at month over month, there's so many different data sets. This is our quarterly data set. You guys, 19%. Think about, so 15% is in like reasonable, I think. That's why I chose it. But again, and I'm going to show you several metro areas that are crashing right now, but people cannot feel it because of this right here. And not only that, new homes from peak are down 16.8%. During the GFC, from here to here, new home value went down 21.8%. We're only 5% away from having a higher price decline in new homes versus the GFC. 5% away from that. And the amazing thing, we're not even in recession. There's literally no unhinged type of unemployment phenomenon. Yes, it's crappy jobs. I get all that. But I was in the GFC, guys. I couldn't even get a crappy job back then. I mean, it was way different. I'm going to show you guys some other cool stuff. But think about what I'm saying, okay? So does everything hinge on values of houses right now? Interesting to think about that. Now let's move on here. This is our national payment to income ratio. This is a little bit about unaffordability. You guys, the national payment to income ratio has gone down because interest rates have gone down. I do want to make a point when you're looking at the national payment to income ratio, it's not counting taxes. It's not counting insurance. It's not counting HOA. As a loan officer, residential mortgage loan officer of over 20 years, I could tell you that's not how we calculate debt to income ratio. That's not how we calculate if someone can afford a house. You have to include taxes and insurance and HOA. They don't do that here, but nevertheless, this is the data. Let's look at it. Okay. We're at 33.4%. Now, that's slightly under the GFC high. In other words, what I'm trying to say, you guys, is things are just so, not only do we have the asset bubble I just showed you, we also have a payment crisis, an unaffordability crisis, because look at how much money goes to paying your mortgage. And this is for new purchases. Okay. If you purchased prior to 2022, you're probably sitting like a king or queen. I want to be even here. I want to be balanced. So king or queen, one of the two. But anyways, guys, I thought that was interesting. Now take a look at this. This is down. The payment to income ratio is down 10% from the October high when interest rates were at 8%. That is dropping the average payment down a whopping $243. That's decent. That's decent. That's $3,000 a year. I like that drop. Sadly, though, things are still overpriced and things are still ridiculously unaffordable. So let's move on to the next thing, y'all. All right. Oh my God, this guy again. All right. Okay. So take a look at it. This is our housing market update on mortgage applications to purchase a home. Okay. So to purchase a home. And I just wanted to point out real quick. Hold on one second. Okay, there. I just had to handle someone because I'm not going to give him any more screen time. All right. Housing market update. Mortgage applications to purchase a home. So, we've been hearing rumors that, the buying demand is back. The buying demand is back. Where's it back at? Where's people flooding the industry? Everything I'm looking at, all the data is 22% down on mortgage applications. We ended sales in the gutter last year back to 1995 levels. Actually, mortgage applications are at 1995 levels. We have a crash in transactions right now. So we have a crash in transactions. We have a crash in prices for new homes, and we have a crash in specific metro areas, not nationwide. That's what I'm trying to explain to you, and I'm getting there. But anyways, mortgage purchase applications are in the absolute gutter. Here's the data. Okay, so be careful who you're listening to and that fear of missing out. Let's move on. All right, here is something intriguing. Okay, so this is the whole inventory thing. The lack of inventory is why prices are high, blah, 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 right? Inventory does matter. I never said it didn't. What I did say is, though, the unaffordability is the bigger thing here, and that will eventually get us back to inventory, sustainable inventory. This is crazy, okay? Take a look at this. So there are 4 metro areas that have more inventory than 2017 to 2019 averages. There's 4. Let's talk about this 4, okay? Because remember, what I'm saying, and a lot of other people I've listened to and watched and studies say, when we do get inventory, prices will go down because we don't even have price discovery, right? We don't even have price discovery in existing. We have it in new homes. We have price discovery going on, but not for existing overall. So I think this is intriguing because of these 4 metro areas that are now above pre-pandemic, every one of these metro areas has year-over-year price decline. Every one of these metro areas that's sitting at, and it wasn't even that high of inventory 2017 to 2019, by the way, you guys. It was like 1.2 million. So we're like 200,000 to 400,000 away. So not really that far. But y'all, San Francisco is down. I'm going to show you. San Francisco is down year-over-year. I'll show you this in a minute. New Orleans is down massively. Austin's down massively. And that's like Lakeland, Florida. Y'all see that? So Lakeland, Florida made the miss. So I was like, I wonder, I haven't looked at Lakeland. I wonder if they're down year over year. So I went here. Look at this. This is Lakeland, Florida. Look at that. Down 5% year over year. Okay. So Lakeland, Florida is down. What? So Florida is declining in the area that has as much existing inventory as pre-COVID. It's declining in fact, every metro area, at least that they report on, they don't report on every metro area, but the big ones, it's down year over year. What does that tell us about inventory? Should tell us it's important, right? So let's move on, you guys. Here's home sales and months of remaining inventory. And here's kind of where I want to make a point. So right now we're sitting at about a little less, I think, according to this chart, 4 months of supply. We need to sustain, not just 1 month or 1 week. We need to sustain 6 months. Okay, it's a balanced market at 4 to 5 but we need to sustain 6 months for a lot more price discovery to start happening. We haven't had the 6 months. The 6 months is more of a buyer's market. We've had like 2 months. Look at this. It was like 2 months from 2020 to 2021. Sellers were king in the housing market. But right now, look at it, it has been going up since 2021. Look at that. And this is supply. Now, I want to point your eyes to over here. This is pre-COVID. So what we were sitting at, you guys, pre-COVID for supply. What were we sitting at? What were we sitting at? We were sitting at almost the same. You see that? So again, pre-COVID, we were also sitting at about 4 months of supply. Now, if we go to the left of this and we go back in time, look at the market before COVID to about 2015 had about 4 months of supply. Are y'all tracking with me? Are y'all tracking with me? Things are changing. It's slow, but things are changing. It's confusing. The markets are splintered. It's hard to know what's going on. When Austin, existing homes, we have this, but new homes this, and then San Diego's different, but yet Jackson, Mississippi isn't. I mean, you guys, this is an insane situation that's happening. And this did not happen during the GFC. It wasn't so deeply splintered. And I'm going to show you a chart on that. Let's move on to the next thing. Okay, here's the comparison I want to make from what's going on right now to the GFC. And this is really kind of scary. You can look at this a couple of ways, but let's start right here where I'm circling. The middle of this chart represents the GFC, and this is home price growth over the time, okay? And what I want to explain to you guys is equity started to go down in 2006. The world, the economy got a warning. You can see the warning. Let me see if I can zoom in for you guys. I'll zoom in for you. Okay, here's the warning. Okay, oh my God, look at house prices have not gone down for what? 7 years at least. This only goes to 1998. Home values went down for the first time in a very long time, starting in 2006. But look at the bulls were like, no, it's rebounded. We've hit bottom. Home values never go down. So look at, you have this tiny blip up right here. See this? And then massive declines in home value. So the market was foolish, went back into the market, people started purchasing again, and then total catastrophe. Now let's compare that to what's going on right now. Now you can see here, we had massive price decline. Do you see that? I mean, you guys, it was massive price decline. It actually exceeded the start of the GFC. You can see that when you compare the blue lines. So the deflation that started in 2022 was faster at first than the GFC, but look at this. Do you see this now? Look at the rebound. The rebound is absolutely shocking. I'm almost speechless because this is no joke, right? I believe this is a type of dead cat bounce, but look at the rebound, you guys. The rebound in 2023 is something for the history books. And again, but remember this, one primary reason that is because we do have limited inventory. And that's why we have that lack of price discovery. It's not like inventory is going to stay this low. I just showed you charts where it's actually almost at pre-COVID. I already showed you those charts. But you guys, this is why right here that I'm circling, this is why this market has been so confusing. It's been so difficult to call. There's been so many people that are bitter, that have resentment because they look at this and they're like, oh, it's rebounded. We're doomed. Fear of missing out. Home values only go up. Look at the rebound. But what I'm saying is this just made the bubble even worse. Do y'all understand what I'm saying? It made the bubble even worse. That is a massive, massive rebound. And I think it's worth noting that. And then so when we ask ourselves, can we really go into a depression? Can we really have a recession worse than the GFC? Well, if the Fed doesn't step in, we will. We know we will. But when I see stuff like this, you guys, this makes me really nervous. Okay, now I'm not saying be paralyzed in fear, but I'm saying beware of this trend. We had our warning. We had our warning in 2022. Back in the GFC, the warning was in 2006. Okay. Our warning was in 2022. So I'm saying food for thought here. Let's move on to the next thing. I love this data. I hope you guys are enjoying the data. Number of share of underwater mortgages. All right. So here's the number of underwater mortgages, which is not a lot. And why is it not a lot? Because people still have equity right now, although they can't access it. They can't get their equity because they're trapped. They have a 2 and 3%. So unless they do a HELOC or a second mortgage, I get it. But a lot of people would have to trade in their low rate for a high rate. So do they really have equity? If they plan on living in the house forever, do they really have equity, you guys? Maybe. I'll say if they sell their house and they cash in, yeah, they have it. But this is what I really want to point out with mortgages underwater. It's near where it was in 2006, where my mouse is. You see this? We are, even though it's super low, okay, it's similar levels of 2006. It's supposed to be low because we're supposed to be making responsible decisions and the dream of homeownership, the American dream of homeownership, right? But look at how fast that changed. Look at that. This trajectory is breathtaking. And that's why I tell you guys all the time, for me, because I had my head in the sand during the GFC, it felt like overnight. It felt like overnight because everything, boom, it just changed and it kept getting worse and it just didn't stop. Interesting to think about. So although right now it's very low, remember the trajectory when we enter recession. So again, the interesting thing is this started to happen before the recession. Interesting, don't you think? But either way, you guys, it's very, very low right now. It's near 2006 levels. So just food for thought. Now let's look at value. Again, I love this update. I really hope you guys are getting good info here. Here's our month over month change in home prices. Now, again, and this is my point, how deeply splintered the market is. Basically, you got things starting to change. This is happens sometimes this time of year, winter months, but you guys can see starting to splinter again. West Coast, all this West Coast stuff, California stuff. People are like, oh, it's not going down in SoCal. I get it. But are you realtors? Do you have access to MLS? I know it feels that way because things are so unaffordable, right? It feels that way, right? Now, what's interesting is month over month, a lot of these Texas metros actually rebounded, which is really surprising. Now, I'm also starting to see the southern states start to fall apart. I'm going to show you guys that in a minute. We had a little bit of decline in Florida, and it hit the East Coast as well a little bit. Here's the middle northern states right here. Little bit of cracking right here. We got a 0.5% month over month decline there, but not too much. Let's look at the annual. So here's our annual home price growth. If you guys don't want to look at from peak, and you can see the rebound. Okay, so this is a pretty good depiction of the rebound. They're not covering every metro area, but of the metro areas they are covering, they only had 5 metro areas. See, Josh is online. They only had 5 metro areas with decline. Okay, year over year. But again, when we throw peak to right now, this changes. And I want to point out 3 of them are in Texas. Why do y'all think that is? Maybe it's because the prices of new homes are starting to expand into the existing market, meaning in order for existing home sellers to compete with the new home builders, they got to play ball. And I think that's exactly what we see there. Now, let's move on real quick. I'm almost done, Josh. I don't know if you can hear me. Where's my headphones? All right. I'm going to show you guys some stuff real quick. All right. I'm going to show you guys some stuff. I really hope you guys love this part. Now, here's San Francisco right here. Okay. So I'm going to go into price real quick. Let me bring Josh in. I hate him sitting there. I feel like a bad host. Hold on 1 minute. Let's put my dude in here real quick at the stage. Josh, what's up, man?
Hey, how you doing, Travis?
I'm doing well. Just doing my report here. So sit tight with me and we'll get some intel from Boise. I'm sure Johnny's online. He'd love to see you. But anyway, so here's San Francisco. I'm going over price right now. San Francisco is showing down 6.7%. And here's the point I want to make as far as looking at peak to trough. If we look at peak to trough, San Francisco is actually down 26.4% right now. San Francisco is down from $427,000. Now, I got in a back and forth with a viewer the other day, and he's like, just really trying to just push the narrative like all the affordable housing is under contract right now. But what he's doing is he's removing data from his point, and he's removing the most important data, which is like the lower priced housing units, condos, townhouses. So I want to show you guys the effect of what happens when you start playing with data to manipulate people and to prove your point. The reality is when we look at the metro areas, we need to look at the entire market. Now, when we purchase real estate, we look at subdivisions. So it's metro and it's subdivision is what I like to look at. You can look at other things like location, schools, things like that. But we're looking at the entire housing market, and we've not done that. So here's what happens, though, you guys, when we start removing things from the data. Look at San Francisco. Let's just look at condos. Okay, first of all, there's 296 units in San Fran. If we only look at condos, look at that. There's 152. There's 152. That's more than half of the inventory this guy's removing from his chart, over half the inventory. You know, I mean, it is what it is. But I wanted to show you, and actually, this would help their case. Condos are up in San Francisco year over year, 7.4%. Look at single family residences, though. So if I chose to, and I wanted to do the same thing myself and remove townhouses and condos and only, cherry pick my data, I can present a worst case scenario for San Francisco, not a better one. It gets worse when I start removing data. So I could have done that, but again, I'm choosing to look at the entire metro area, but look at the decline. You guys, the decline of only looking at single family residences in San Francisco, they're down from peak almost 30%. Almost 30% from peak if we just look at single family residences in San Francisco. Why is no one talking about that 30% from peak? All home types, boom, okay? Why is no one talking about this? I'm almost done, Josh. I'm almost done. All right, now take a look at New Orleans. I wanted to show you guys a few metro areas to bring this point home. So here's New Orleans as well. New Orleans is, you guys see what I'm saying about how splintered the market is? Like, I understand people's bitterness and resentment. It's hard to understand. But look at New Orleans, not from peak. From peak, New Orleans, from peak is down $100,000. From peak, it's down 25%, which is from here, from June 2022. It's down 25% right now. By my definition, that is crashing prices. Crashing prices in New Orleans. But take a look at this, guys. When I remove the condos, it gets better, not worse. So why are people removing the data? And if I just look at single family residences, look at how bad it really is. So again, if I wanted to cherry pick data, I would just use SFR in the metros that I wanted to put my data, but I'm looking at the entire housing market. SFRs in New Orleans on year over year basis is down 16%. 16. The thing is, guys, no one's talking about this because they can't feel it. They can't feel it. Why can't they feel it? Because the equity run-up was too great and too fast. But nevertheless, you guys, New Orleans is in the absolute gutter. Here's Birmingham. I'm also following Alabama as well. I wanted to cover some of the southern states. And look at, again, the same thing. It's down 6.8% year over year. But from peak, Birmingham is down 20% from peak. 20% from peak. And again, when we start playing with these numbers, let's look at condos. Condos is up. It's not down. But when we look at SFRs, look at that. It's way worse. Way worse. So obviously, and this is year over year. Year over year is taking the seasonality out. So you can say, oh, this is seasonal. And that's why we have year over year. So we don't have to play that seasonal game. It's down 16.6% year over year. 16.6%. No one's talking about this. All right, now take a look at this. This is what I'm worried about. Okay. What you're looking at right here, and I'm going to do a video later on Redfin housing market data. It's going to be a really good video. I hope you guys watch it. But this is what I'm paying attention to. Look at the months of supply. So we peaked, I think like 2 weeks ago, months of supply. We're at about, I think, 4.6 months. But look at the trajectory, and I'm talking about that blue line. Look at this trajectory. See that just plummet downward? Now, remember, that's what happened in 2023. Supply just started plummeting as soon as we basically got to the end to middle of February. So if we really are going to get price discovery back on a nationwide average, we need to be following this data set. All right. This is going to tell us, are we getting more inventory than there is demand? And right now that trajectory is headed downward. So if I was concerned about anything, that would be the thing that I would be concerned about, and I will be watching. And again, you guys, last thing here, and I want to get some intel from Josh here. The markets right now are incredibly splintered. They are incredibly splintered. We didn't have this type of diversity during the GFC. It's kind of like during the GFC, we all went down together and we all came up together. We had a 2006 and a little bit of 2007 warning. But right now, we've had a massive warning in 2022, but the rebound is incredible. And look, and it makes sense why it's so splintered. How could New Orleans, Birmingham, Jackson be down 20%? And no one's talking about it, when the average price decline during the GFC was 19%. The reason is, again, people not only can't feel it, but we also have metro areas in Anaheim, in San Diego, Central California, out East Coast that are up, that are actually up, that have not started cracking. They've slowed down significantly, but they have not started cracking. And we need to understand this is one of the reasons for so much confusion and uncertainty. And I believe a primary reason is no one can fathom the money printing. We can't fathom $1 trillion. People are throwing around $1 trillion like it's a common word. It's not. Trillion is a lot of money. So anyways, that's a real estate update. Josh, how are you, brother?
I'm doing pretty good. Thanks for having me on again.
Yeah, of course, man. So you guys, I brought Josh in here. He's going to give us a bit of a report, boots on the ground. And what do you got, Josh?
Yeah, so I just kind of wanted to elaborate a little bit more on this, on new construction, because in the Boise metro market, there's a lot of new construction, and that's what's kind of driven our economy a little bit. And so I wanted to just bring over the year over year or the year to date stats here. So in Ada County, essentially the Treasure Valley is made up of 2 counties, Ada County and Cannon County. And so for Ada County, we saw about a 14% drop year to date from 2022 to 2023. And what those numbers look like is at the end of 2022, the year to date for new construction was 635,000 was the median sales price for new construction. And then for new construction in 2023, it dropped to 547. Now, that's 14%, but if we go from peak to trough, that's a 20% drop. And keep in mind, a lot of these builders in our area are offering $20,000 to $45,000 in seller concessions to help you buy down your interest rate, or they're offering the trap of the 3-2-1 buy down. And so that these numbers don't even reflect that, right? They just reflect the sales price. And then if you jump to Canyon County, which is kind of on the outskirts, what ended up dropping from 2022, we dropped from 495 year to date to 420. And in the peak, new construction in Canyon County was 535,000. And the reason why I want to bring this up is because that's why we're seeing some of these subdivisions going into having a notice of default, right? They started developing and their performance was based on that higher number, the higher 20%. And now since those home values are down so much, whether it's townhomes, single family, or even the ranch style homes, when these values are down substantially, the developers and the builders can't sell. Now, there are homes selling, and I don't want to overlook that, right? We have a lot of builders that are now building in the low 300s, which we hadn't seen in a while. And so those homes are still moving, especially when you're getting an extra $20,000, $25,000 to help you buy down the interest rate. But that's why we're seeing such a price decline, and why we've started to see some of these new constructions going into notice of default. So I just kind of want to bring that to light of what's going on here in the Treasure Valley.
Okay. So Josh, if you can, man, and I know you have access to MLS and you're a broker, so you actually study the data, not so much your feelings. Seems like
Right.
everyone's using their feelings to tell us how the economy works now. Although I would argue feelings are important, like shockingly important when it comes to the economy. Like the sentiment is just so powerful. So, when we did that video, we had some people come on like, oh, everything is rebounded, it hit low. And I'm just like looking at some of these comments like, are you guys wackos? Or like, what do you, we're showing you everything. What are you talking about here? Yeah. So can you explain like why might some areas in Boise say have appreciation? I mean, you kind of explain this, and why other areas do not and appear to be crashing. Can you just give us an overall breakdown of why, again, some areas are going up, some areas go down? And do you see less migration into Boise compared to 2021, let's say?
Yeah, absolutely. So the migration has definitely slowed down. I mean, we can see that through charts, through Redfin, through Realtor, through United Van Lines, through all these different moving companies. We can see that the trend has dropped substantially. I believe there was like a 60-40 split where 60% of people were moving in to the area and 40% were moving out. And I think that number right now is about 52-48. So it's definitely shifted substantially. The other thing too is the pending sales and then the solds. So our solds have dropped substantially. For the last 2 to 3 years, we've seen a drop of the sold units drop about 15, anywhere from 10 to 15% year over year. So we've seen that drop steadily for the last 3 years. And the reason why some areas may seem like they're not crashing is because the price points are just dropping slower, right? It doesn't mean that it's not crashing. It's just every area in the Treasure Valley has seen price decreases. Just some areas have seen price decreases higher than others. And part of that is, the lack of lot inventory or the lack of new construction. But the whole area, the whole Treasure Valley is seeing price decreases. So it's not just, I wouldn't say there's one area that's like, oh yeah, we're seeing actually growth in our home prices versus declining. It's just some are coming down slower than others.
Couple things, man. I got a couple questions. First one's obviously from Johnny. So he's wondering where he should move to in Idaho. He's thinking Twin Falls, Napa, Middleton. What do you think, man?
Yeah. So Twin Falls, there's not a lot happening down in Twin Falls, but yeah, if you want to move down there, people like that because it feels a little bit more rural. You have a little bit more farmland, that kind of stuff. Nampa and Middleton, kind of same thing. But problem is Nampa, Canyon County, which is Nampa and Middleton and a couple other cities, normally have the highest tax rate. So people don't like that. They get a cheaper house, but then they have to pay more in property taxes. As far as like, it depends on what you like to do. If you like to run it up into the mountains and go camping every weekend or get on the lake, then probably Boise, Eagle, Star is probably better. It just depends on where. So,
all right, got another one for you here from Nikki. Are California still moving to Boise? Has it stopped?
Yeah, definitely. We still have people moving in here, and I think that kind of shows, right, the 52% of immigration versus the 48% of people moving out of the area. So Californians, Washington, Oregon, those residents are still moving here, and some of them have actually moved here and they're renting because of the unaffordability isn't here, and they're just waiting for the affordability to get back into place. So,
okay, awesome, brother. I really appreciate your time. Oh, I got some super chats I got to throw up real quick. Funny. Okay, so my wife needs the truck keys. Answer this question real quick. My God. All right. Let me just disappear real quick as my wife. But so Don't Move wants to know if manufactured housing tends to mimic single family residence. Can you answer that question?
yeah, absolutely. So if I'm understanding correctly, you're asking about like new construction, manufactured, new construction single family homes versus manufactured, like a mobile home type thing. So we aren't seeing.
I don't know if
go
you.
ahead.
I don't know. You like how I did that real quick?
Yes.
Sorry, Shara. But I don't. He didn't say new SFRs. I think he's just talking just the market overall.
Market overall, and we're talking about mobile homes, right? I just want to make sure we're talking about mobile homes versus single family.
Manufactured. I think that's what MFH stands for, manufactured housing.
Okay. Yeah. So we don't see a bunch of mobile homes here in the Valley. We do have some of those mobile home parks where somebody will be renting a lot. There's not a lot of those.
Multifamily. I apologize. It's multifamily.
Okay. Yeah. So I'm glad we clarified. So multifamily, we have a lot of multifamily currently being under construction throughout the Treasure Valley. And with all these doors, the problem is we have so many finished manufactured, like multifamily developments that are sitting vacant. And so they're getting incentives. I mean, we did a boots on the ground a while ago where we called the apartment complexes and said, hey, are you guys offering any incentives, that kind of stuff? And it came out that some of these were offering 2 months free rent just to get you into the place. And the mix of what's going on here, in my opinion, and based off the data, is we're seeing that people have bought a house that maybe they aren't living here anymore and they have to move out of the area. So they throw their house on the market as a rental because they can't sell it. They can't sell it without taking a loss. And so now you have a single family home competing with an apartment complex. And most people, if they can pay the same amount for a single family home, are going to move to a single family home versus an apartment complex, which is really putting downward pressure on the apartments. And right now that doesn't even include all the new apartments that are going to be hitting the market that are like halfway finished right now, because there's a handful of multifamily developments that are currently under construction. So hopefully that answers.
Okay, awesome. I got to throw up some super chats real quick, man. Hey, I really appreciate you. No Country for Dying Breeds. I don't know if you guys have watched No Country for Old Men. That is a great movie. I don't know if you've seen that, Josh. No Country for Old Men. Have you seen it?
I have not seen that movie.
Oh my gosh, it's a great movie. It was made around the same time There Will Be Blood with Daniel Day-Lewis. Have you seen that?
I have not seen that one either. Sorry.
Fantastic movies. You should check it out. Okay, so appreciate you, No Country, for Dying Breeds. I always appreciate the support. That means a lot. He's saying he appreciates the content. Any market where houses are still double the 5-year previous is a no-go for me. And he's talking about entire markets. There are still markets that are only up 20 to 30%, so they should benefit, not the money grabbers. What he's saying, I think, is like, although it may not be a good business for like flippers right now, and I don't want to, speak for him, but I believe what he's saying is you can still potentially find good deals, great deals in some markets. But like in markets that are like double 5 years ago, maybe that's San Diego, maybe that's Anaheim, he's going to stay away. A little bit hopeless out there. But in the other markets, again, what we just went over, Boise, New Orleans, San Francisco, Austin, it's off peak. Essentially. So I think that's what he was saying. I really appreciate those comments. I got one more, Josh, and I'll see if we've got any more questions for you. When will Real Estate Mindset member dividends start being paid? Sir, this isn't clear tax value. I haven't sold any crypto to my channel. Do you know that he turned... Anyway, so I won't even go there. I don't want to offend people. Anytime I say anything negative about clear tax, I just get ripped up, bro. Like, so I'm just not going to do it. But I will say you're on the wrong channel, brother. That's clear tax, and you can't touch that for a year, and it's super high risk if you look at the SEC filings. Anyways, I feel like he set me up for that one. I don't know.
Yeah.
Maybe he. I love that guy so much. All right, let's go back and see if we got any more questions for you, Josh, and I will let you go.
Awesome.
Josh lives in Idaho. He gets outdoors. What does this say right here? I'm still renting SFRs are way slower because many. Travis just lives in Idaho. He goes outdoors and doesn't stay inside to watch movies. Okay. That's okay. I'm glad that we.
That's a fair statement. So.
What'd you do yesterday? Were you outside yesterday?
Yeah. Well, yesterday was a mix of taking care of some brokerage related things, and then went for a jog. But we woke up with it's snowing out here, so there's not going to be much outdoors unless we go to the mountains to ski. So,
all right. Well, I appreciate you, brother. Cool. I don't know if you want to stick around or get out of here, but I have to move on to the next part of this, which is going to be a video on Powell's 60-minute interview, and it's going to be by Danielle DiMartino Booth, who is the Chief Strategist and founder of QI Research, and on top of that has a 9-year career as an advisory to the Federal Reserve of Dallas during the GFC, and she specialized in like unconventional monetary policy. So I have an interview. I have an interview with her later today. I'm super happy about it. I've been preparing for that. But anyways, brother, you guys don't forget to go to Josh's channel. Josh, plug your channel real quick, brother, if you can.
Yeah, we're just Good News Real Estate. At GNRG is our YouTube tagline. So I appreciate you having me on here, and good luck for the rest of your day.
I appreciate that, brother. You out?
Yep, I'm out. Thanks.
All right, man. Hey, I appreciate everything. All right, you guys. So here's his channel right here. If you guys want some more news, especially if you're in the Boise area, I see you, Josh. I could still see you. Hold on, let me remove him. I love videos, you guys. But here's his channel right here. If you guys want some more information from Josh, anything in the Boise area, definitely appreciate his time. We're going to go into our next video now, you guys. Again, this is going to be from Danielle DiMartino Booth. He's back on. That's funny. I don't know what's going on. Very good stuff. She's going to go into why Jerome Powell said what he said. If you guys don't mind, please let me know that the audio is BN. Okay. I'm going to get you guys set up right now.
Chief Strategist Danielle DiMartino Booth, and I do want to get your thoughts. Let's start with the Powell interview. I mean, he went on 60 Minutes. What was he aiming for? Why did he do that?
Charles, I think he went on 60 Minutes because of how he ended the interview by saying that integrity is something that you can never lose, and the only thing that you take with you, by using words that are really fighting words like adult conversation. He is saying unequivocally that the past sins of his predecessors at the Fed have facilitated really naughty behavior in Congress and in the White House and in prior White Houses, and that it's time that the Fed stop facilitating the overspending by keeping interest rates at unusually low levels, that he's not going to be playing a part in it. That's why I think he went on.
You know, but here's the interesting thing. That, to your point, I love that you pointed out the $1.3 trillion that was given out in relief, to all those relief programs. Didn't have to be returned. $1.9 trillion, of course, from the COVID thing. On the screen, we've got U.S. government balanced budget. This is like the worst balanced budget going back except one administration. So this, I think, is why the economists keep getting it wrong. because there's no way to really factor into these old models an additional $6 or $7 trillion. But at the same token, though, has the Fed to a degree facilitated that? Have they sort of I mean, despite what Powell's saying and what maybe he doesn't want to, but the Fed itself seems designed to facilitate the mismanagement and the recklessness of the federal government these days.
Well, just bear in mind, Powell is coming under increasing pressure to lower interest rates, but it was the Fed's actions monetizing every last penny of profligacy that was legislated immediately following the pandemic. Programs that were designed to be $50 billion that are now 10, 12 times what they were originally legislated to be. But it was indeed the Fed that monetized that debt at the moment in time when interest rates were at the zero bound. So they encouraged Congress to spend money by making money so cheap. And I think he's recognized, last night to me was a tacit mea culpa, that they're not going to be a party again to this kind of waste of taxpayer money. You just mentioned $1.3 trillion, really, that nobody even talks about, that went to some of the wealthiest Americans. I mean, to what end? Nothing for productivity.
Right.
It was simply, let's put the whole family in the front of the plane, first class, and let's go to Paris and go shopping on U.S. taxpayer money. Jay Powell knows that he played a part in that, and he knows that he does not want to go down that road again. And I take my hat off for him for saying, I'm not going to do it twice.
But he's going to be pressured, though. I mean, listen, I got a minute to go, Danielle, but to your point, you can sense maybe the action in bond yields, the reaction in the stock market to a degree, but there's like euphoria out there. I mean, just about every expert is saying, yeah, rate cuts, not March, okay, May, they're coming. The Fed's going to be accommodative. The Fed is on our side. It's up, and away from here. So if he was trying to tamp that down, I'm not sure he succeeded.
Well, look, it's going to come down to actions following his words. If it really is only going to be 3 rate cuts in 2024, that is certainly not going to cause investors to run a victory lap at all. For you to say to them, oh, we're going to be at 4.5% by the end of the year, that has nothing to do with the 0% that they are asking for and begging for,
right,
like babies who want their pacifiers. If he just stands pat, 3 cuts this year, investors will not be happy, Charles.
Yeah, what was remarkable to me is how much of the rally is baked in, is under the assumption that the Fed's going to cut 5, 6, 7 times this year. We'll
That's
see.
exactly right.
Yeah.
And you know what's so interesting about the market getting it wrong like that is it prices in these rate cuts. So when they don't have the rate cuts, you guys, I mean, it's a little bit crippling. I want to show you some info now on how the market has been constantly wrong as far as like what the Fed's going to do next. This is from Frog Capital. I actually found this guy from Jack at Nobody Special Finance, and I loved his charts. This is from the Wall Street Journal. And this is basically saying investors are almost always wrong about the Fed. And I want to ask you guys, why do you think investors and economists are always wrong about the Fed? Do you guys think it's because they're paid to push a narrative? Is that why they're always wrong? I mean, why do you think they're always wrong? To me, it's because they're getting paid to be wrong and to try to appear right. Isn't that how that works? They are paid to appear right, but to be wrong. Is that right? I don't know. Comment below. Maybe I'm wrong here, but we can see right here. I mean, the market is all messed up right now. What's very interesting as well is if you look back at 2010, the market was anticipating the Fed to increase interest rates from 2010 to 2015. Look at all these upper lines right here. They were like, nah, we're just going to keep them low. I mean, this is bad. We want higher interest rates. The low interest rates were killing us. But nevertheless, look at the market. And right now, look at how the market is fighting the Fed. The market has been pricing in Fed rate cuts for a year and been getting it wrong the whole time, like really wrong. I remember there were people saying in 2023 that interest rates were going to go down to 2%. Do you guys remember that? There were people saying in 2023 rates are going down to 2%. Federal funds rate, not mortgage rates. We're talking federal funds. So again, the proof is in the pudding. Here's it showing it right now. Everyone is like, please lower rates. Please lower rates. Oh my God. Oh my God. Oh my God. They keep getting that wrong. And by the way, you guys, I forgot to mention, this is our liquidity update right now. I'm going to put a timestamp on this. So this is our liquidity update. We're basically going to go through liquidity and we're going to go through the market. That's what I'm showing you guys right now. So take a look at consumer defaults. That's something that we haven't had spike to like GFC levels yet, except for a couple categories. But here's what I wanted to show you. Again, this is from Frog Capital. Big shout out to Nobody Special Finance. This is where I saw this. This is really important because when consumers stop paying, everything stops. When consumers stop paying, things go bust. When consumers stop paying, because we're a debt-driven economy, obviously. So this is going to show you who stopped paying, okay? And this is interesting. Okay, so you can't really see it too much on the 90-day delinquency. 90-day delinquency, at least for vehicles and credit cards and vehicles, is pre-COVID. Okay, it's actually higher than pre-COVID. But that doesn't mean a lot, right? What does that mean compared to the GFC? But when we look here, you guys, this is delinquency for 30 days. Now, let me explain. When someone has a 30-day late on their credit, their purchasing power is done. Your credit score can drop 100 points with just one late payment. So again, any of these people that are behind 30 days, they destroyed their ability to get credit. All right. More than likely, it depends if they had an 800 credit score, but most of the people are like 700 credit score, one late payment, you're down to 600. You can't even refinance. You can no longer even refinance your house. If you're late, it hurts you drastically. Now look at the trajectory now of the 30-day late payments on auto loans. This is freaking insane. This is crazy. And we're talking about trajectory now. Okay, so we're talking about like what direction is it going, right? The trajectory of auto loans is insane, you guys, and it is at 2010 levels right now. So as far as auto loan delinquencies, we're talking about 30 days, right? 30 days, that's crazy, and that's almost 8%. That's 2010 levels. That's right outside the GFC. That's right outside the GFC. Right when we started to heal, that's what they're at. And if we go back to before the GFC, look at, they're matching what, 2006 again? And look at the trajectory. It's shooting upward. Keep your eyes on auto loans. That could destroy regional banks especially, and other banks as well. Look at credit cards. Credit cards is like, holy moly. So this blue line right here is the credit cards. The green line was auto loans. This blue line for credit cards has been absolutely skyrocketing. I mean, the delinquency rate on 30 days is freaking nuts. Is well over now pre-COVID. Pre-COVID credit card delinquencies, which was about right here, were a little over 6%. Looking at this graph, they're now over 8%. So credit card delinquencies sky high, and the trajectory is going almost straight up. Okay, this means consumers are not well off. Consumers are not that strong. It's just they have an ability to spend, and because of the ability to spend, that makes them appear strong. But what I'm saying is if you keep spending your credit card, you're trapping yourself. You're part of the rat race now. You put yourself in a financial prison. Stop spending. But look at, guys, when we go back to the GFC, credit card delinquencies, again, same like auto loans, going back to about 2011. And if we look at the GFC, they're actually at 2007 levels, right before we went into recession. So credit cards are right at the same levels as far as 30-day delinquencies, right at the same levels of 2007, entering the recession. That's going on right now. But let's keep going, okay? Mortgages, however, are low. So mortgage delinquencies are super low. But again, I want to bring your eyes to the trajectory, because all we hear is about how great the market is for foreclosures. But what I'm also saying is that is drastically changing. Homeownership is completely different now than it was in 2021 and 2020, a little bit into 2022. But the trajectory, y'all. So the trajectory of delinquency in mortgages is going up, and it's going up at a pretty healthy rate. Now, we're not quite at pre-COVID. You guys can see that right here. But I also want to direct your attention to GFC. GFC, we're sitting at about upper fours, lower fives before going into recession. So and I just want to remind you guys, before we entered recession, the trajectory was downward for delinquency on mortgages. Did y'all hear me? What is all of this? It means that we got to think outside of the box, because if you would have looked at this right before the GFC, mortgage delinquencies are going down. Everything's okay. They went down and then they shot up. Right now they're going up. What do you think is going to happen with recession and unhinged unemployment? Do you guys think it's going to shoot straight up like that? It's possible. Now, school loans, not even worth talking about. Let me show you guys FHA real quick. There's been a lot of people not understanding FHA. So FHA has always had higher delinquencies because the guidelines are looser for buyers, meaning that you don't have to be as well qualified as conventional mortgages, which do have a low delinquency rate. But look at FHA, you guys. So we're over pre-COVID. Okay, so pre-COVID is right down here. But also understand that pre-COVID, we were sitting at about 8% delinquency. So right now, I believe we're close to 10%. So we're still elevated, but I wanted to make a point that it has always been high, but not like this high is a little bit abnormal. It's breaking trends a little bit. You guys can go again back to the GFC. Excuse me. You can see that FHA delinquencies were going up and down, but they were about 10% to 14% going into the GFC. And right now we're right knocking on the door of 10%. Okay. But there's a but here. Okay. GSE. So like conventional mortgages, it's low. It's low. The trajectory is going up. We just looked at that right here. Okay. Trajectory is going up, but historically it's low. So that's another reason for the lack of inventory. Obviously the moratoriums help this. Let's go on to the next thing here, guys. All right. Let's go into the 10 and the 2. Okay. Here's where we're sitting at with the yield curve inversion. This is one of the biggest indicators of an incoming recession. This is something that investors are watching to say, hey, there's turmoil. And I also want to make a point that we have been inverted, meaning the 2-year Treasury interest rate is higher than the 10-year. It's supposed to be the other way around. You're supposed to get more interest the longer you have your money invested. So right now, we like dipped in April, but I'm saying sustained inversion. So we've had a sustained inversion for 19 months. 19 months. I believe if we hit 22 months, we'll have a new record. And this makes sense. This inversion makes sense because we have more money to be burnt out of the system. We really can't fathom how much money was printed during 2 years. We really can't fathom that. And this is keeping us inverted. I think that money stockpile is keeping us inverted because the lag effects are just like almost speechless. Like, I can't believe it's taking so long, right? So that's the inversion, you guys. 10 and the 2, it's only 31 basis points. We've kind of been here since about October of last year. Downs and ups, downs and ups. We kind of leveled up since the middle to beginning of last year, but keep your eyes on that. If you want to follow the recession, this is one way to do that. Now, talking about liquidity, we haven't had a lot of moves here. This is a reverse repo market. This has gone down about $20 billion since Monday. So this has been going down, but we didn't have a drastic week over week drop. Although 20 billion, you see how I'm just throwing $20 billion around? Like I've got used to saying trillion. Now I'm just throwing billions around. Shame on you, Travis. $1 billion is still a lot of money. So 20 billion gone week over week. There's still a lot of liquidity. I think this is going to be up around May. A lot of other people are like, no way, Travis, this is going to be gone in March. I've heard other people say this is going to be gone in February. But when I kind of look at how long does it take to drain, I'm thinking May. I'm thinking May. This is going to be done. We'll keep an eye on that. But that is a lot of liquidity. Look at the other money here in the market. This is the other money. This is the Treasury General Account. This has been going up. Actually, this went up, I believe, week over week. Where's my week over week? Actually, no. Okay, it didn't update again yet. Actually, it updated Wednesday, but we were going over this on Monday at 8:41. So this has dropped 41 billion since Monday. So this is down 41 billion since Monday. So it's down, but this is another area of like liquidity injection that would not be good for our economy, depending on what happens next. Now look at this, guys. This is the total assets. I haven't gone over this in a minute. This is the total assets held by the Fed. This is not just the MBS, mortgage-backed securities. This is the total assets. They have 7.6 trillion right now in assets, the Fed does. So who's in control? Whoever controls the money, right, controls the market. Who's in control? Consumers are in control, but also who's in control? The Federal Reserve. They got more money than we can even fathom right now. They got 7.6 trillion. They have that. That's insane. Burn it away. All right, here's mortgage-backed securities. So mortgage-backed security, this is the quantitative easing, quantitative tightening. This is what quantitative easing and tightening looks like. Basically them buying mortgage-backed securities. Okay, so here's the quantitative easing. I'm going to buy mortgage-backed securities. Oh, quantitative tightening. We're not going to buy anymore. We're going to sell or let it roll off our balance sheet. But I wanted to let you guys know this is one of the primary reasons that we're in the situation we're in, because they were artificially lowering interest rates by purchasing mortgage-backed securities from companies, say like Chase, that were offering us 2.1% interest rates. This is a very bad deal right here. So hopefully they stop this. We want them to stop buying mortgage-backed securities, which appears that's what they've done. But nevertheless, you guys, there's still a lot on their balance sheet, 2.4 trillion. Now let's end here. This is M2 Money Supply. All right, so M2 Money Supply is up. We've had a recent tick up since about October, the end of October. So M2's been going up. That's probably why the stock market has rallied, amongst other things, foolish optimism. But keep your eye on M2. Also want to bring to your attention, it kind of started going down in 2023. This is the first time M2 has gone down since the Great Depression. And still, the market has not went into recession. This tells us there's still money to be burnt, not from the people on the bottom. We're dying, but from the people on the top, from the elites. They are the reason why we've been in this situation so long. I mean, change my mind on that. I mean, seriously, okay? All right, let's move back over here. We're going to go into our next video. You guys, this is a little bit longer live, but it's Friday. I'm happy to be with you. Don't forget, start your week with me. I'm going to be back on Monday. Monday's Friday. And Fridays. All right, let's do our next video right here. I'm trying to speed this up, y'all, but this next video is about this is about regional banks and the health of regional banks. So the guy's going to sound worried about other banks, and he's going to sound confident about his own bank. But I want to ask you guys, do you think he's nervous? And he's going to go into commercial real estate, and the fact that is actually a massive problem that's being underreported. Let me know if you guys can that the audio is okay. Enjoy the.
We're now on the challenges facing regional banks. The cratering of New York Community Bank once again raising concerns whether other banks may face similar issues. Joining us now is WaFd Bank President and CEO Brent Beardall. Brent, welcome. Good to have you with us. It's been, by any standard, a rough year for regional banks. Maybe not including yours particularly, but it's hard for the stocks to make much progress in this environment. What do you say to investors who are concerned about the regional bank space generally, and how do you differentiate your bank from those that have run into trouble?
Tyler, good to be with you, and some very good questions, and investors are rightly asking those questions. And I would say regional banks are really very strong today. Obviously, what happened last spring, that was a crisis of confidence about the depositors. Were their deposits safe with regional banks? And there was an over-reliance on uninsured deposits on the banks that failed last year.
What?
And that simply is
Yes,
not the
this is
case
the guy
now.
from Todd's.
If you look at New York Community, I think
I didn't realize
three-quarters of their deposits are insured deposits. And really, it
That's the
comes
guy.
down to a credit quality question, something that we've all been asking the question since the pandemic started. What would happen with the values of commercial real estate? And then even if you look at commercial real estate, one of my personal pet peeves is that is far too broad of a category. We need to ask what types of commercial real estate. And within commercial real estate, I think the real question is how much office exposure and what does that exposure look like?
Well, there's commercial real, as you point out, there's commercial real estate, and then there's commercial real estate. There's offices, industrial, retail, apartment buildings. With specific reference to WaFd, how much do you have of your loan book is in offices?
A great question. For WaFd, we are only just under 5% of our portfolio is office. And I'm very happy to tell you that we don't have a single delinquency in office. And we run current valuations on that portfolio. And right now, I think our loan to value is 64%. So I feel very confident where we are, right? But you never know. And the one thing that really feels good about office now, compared to a year ago or 2 years ago, you're getting more people coming back to the office. And you know, it is interesting how we get so worked up about certain segments. If you go back to when the pandemic started, one of the segments in commercial real estate everyone was worried about was hotels. What's going to happen in hotels? Nobody's going to hotels. No one's traveling. And who would have thought 3 years later, hotels are back to booming? In fact, many of our hotel operators are reporting profits that are 20, 30% greater than where they were in the pandemic. So something tells me that we'll figure a way as a country to figure out what to do with these office spaces.
Sell them for pennies on the dollar. Maybe that's what they're going to do and figure out to do. I don't know if you guys agree with me, but that's all I really wanted to cover with that, y'all, because I just wanted us to understand that there is a lot of turmoil behind the scenes that people don't even know about. And a lot of these banks, specifically regional banks, hold commercial real estate offices, industrial, things that are not performing. And they owe like billions and billions of billions. And that is another part of the lag effect. Like they're holding out, hoping and praying that Jerome is going to lower interest rates in time for their balloon payments that are due, that they need to refinance, obviously. Keep your eyes on that, you guys. We have a lot of things going on that people are watching. We have the lag effects. It's probably the strongest thing, right? What is the lag effects going to do? Oh my gosh, we're waiting. We have geopolitical stuff. I mean, we got wars all over the place. We have, and if people don't listen to me on this one, but China's collapsing. They're collapsing right now. We have that. And then the commercial real estate. So we have a whole bunch. And then obviously consumer delinquencies. We don't even know what's going on behind the scenes. We got a lot going on. But remember what I'm saying as well. The market is drastically splintered. Things are not happening the same way they did in the GFC, where it was more uniform crash, rebound, crash. Right now, it's like crashing here, but then we got a rebound, but over here it's crashing and it's still crashing. Over here is not crashing. Over here rebounded. So it is all mixed up right now. And the story is still being told. Don't forget that part. All right. Now I'm going to show you guys how to set up. All right. Now this is going to be cool. This is going to be our last thing, and I'll do some Q&As. Sorry for the time, but you guys come back to this chapter. I want you to pay attention. Now, if you are out there investing in real estate, and especially if you're a realtor, or if you're going to use a realtor, explain to your realtor how to do this. Take out my earbuds. My gosh, I'm yelling because the earbuds were in. Have to adjust from that. That was crazy. But I'm going to show you guys how to set up a search to find great deals. All right. So again, if you're a realtor or if you're just a regular person, I'm going to show you exactly how to do this right now by doing this. Okay. So here's the matrix. Here's what realtors generally have access to right here. Okay. Now, first of all, let me show you the map. Okay, so in Houston, there's like, I don't know, 20,000 like homes for sale right now. I mean, I don't know how many exactly, but I think it's about 20,000. I don't know what it is today. But that's too much. That's too much data. Like, where's the great deals? There's 245, 137. So what you guys do, and this is what I'm doing myself as I'm looking for property, I set up my characteristics. So say I want a minimum house of 3,000 square foot, maximum 4,500 square foot. Okay. But what I have done on my matrix is I added an additional field. See where it says additional fields right here? Again, you can have your realtor do this. And I put price per square foot. And I've been trying to show you guys it's a great place to start. More due diligence needs to be made after price per square foot. But this is a good way to like clear out a whole bunch of overvalued houses to see where's the good deals in the metro. Where's the good deals? I mean, all you got to do is you put $50, say to $75. Okay. Let's see. That gives me, that's really low. Let's go to 100. Okay. Okay. So instead of 20,000, I have 148 matches. Y'all tracking with me. We don't have to stress. We know what's going on right now. I can find decent deals right now. That's what I'm trying to tell you. Let me show you the map. Okay. So there's 184 now. Look at, there's no longer 20,000. So if I was interested in the Westfield area, here's a comp. If I was interested in Rayford Spring area, here's a comp. You know, Alden, here's a comp, right? Houston, Crosby, Atascocita. Look at this. We don't have to guess. I mean, I've just filtered this within seconds to show you, especially if you're an investor. I'm not saying that I'm trying to help investors, but I am trying to give you tricks that investors use so that you can empower yourself to find houses. I mean, look at this, guys. It takes a lot of the guessing. And so what I would do next is say I wanted to get info on, let me see, this house right here. So remember what I'm telling you, every subdivision is unique. Like this subdivision right here is different from this one right here. So what I would do is say, oh, here's a great deal. Let me click on this, right? So $90 a square foot. All right. So the next thing that 51 days on the market. So the next thing I would be doing is a market analysis on, the subdivision, Northwood Minor. Okay. So that's the next thing I do. I filter out the data so I can see an entire metro area. I don't want to see 20,000 comps. I want to see a handful so I know where the great deal is. And then after that, then I start reviewing and analyzing the subdivision. Now, you guys, when a crash happens in this metro area, instead of, 148 houses spread out like this, all a crash is going to mean, and this is why you don't want to just wait on the sidelines. You want to be preparing. You want to be understanding. Obviously, I still think it's way too soon overall, but there's some great deals. A crash is going to have these types of properties all over the place. That's really what a crash is. Let's be honest. Okay. So So FYI on that. I hope that helped you guys. Again, Monday I'm going to do a market analysis again. I'm going to keep showing you guys that just because it's confusing to a little bit of people, and I want to just keep showing you guys use the data. It's never been a more important time to use the data. So let's switch on over to the Q&A real quick. So if you guys have some questions, shoot them up as I do. Go to the starred questions real quick. Okay, so shoot those up. First question here is that one guy. I think we all understand that Texas, Nevada, Florida, and Cali are in rough shape. Let's talk about the upper Midwest and why things are different there. So a couple things I think that Midwest, I need a report on this and more deep dive, that one guy, but I would say affordability and the lack of new construction, straight up. And whoa, let me take a step back. When I say affordability, I mean comparing the rest of the nation. For the locals, it's bad. For any local, it's usually really, really horrible. But I'm saying compared to the rest of the nation, I would suspect that has been resilient because of it's relatively affordable and there's a relative lack of new construction inventory. And so there you need to wait for the lag effects. So whatever's going to happen is going to happen. But that's why I believe it has sustained better off than, say, southern states that are absolutely in distress right now. We got a question for Joe from Joe. Hey, Travis, is it possible for a 13-year rate to be higher than a 30? It's possible if you're working with a dishonest loan officer. Because remember what matters with interest rates, the price. Remember, a 15-year rate should always be lower than a 30-year rate conventional. We're talking conventional. We're not talking FHA, we're talking conventional. 15 year should always be lower than a 30-year. Should always be lower, but you got to watch the pricing. A dishonest loan officer can flip that on you because they'll charge their fees in the pricing in the interest rate. I hope you guys understand how that works. So always get the pricing or cost of the rate you're being quoted. Here's a comment for Dean. Cash is king. Don't give the banks all that profit. I mean, I agree, you guys. I mean, the bank runs, holy smokes. I mean, that's why I debanked most of my money, my down payment, and I put it in treasuries. Bought a little gold, little bit, not much. And that's what I'm doing. I'm sick and tired of these banks making money off my money and not even giving me money. All right. So from Les, most people move every 7 years. So payment is all that matters as long as they don't mess with your equity. So that's not all that matters, Les. What matters is the equity, because if they want to move, they usually have to have equity or they have to come to the closing table with whatever they're upside down. But I think what he's saying is like so long that they don't refinance, right? And I got to tell you guys, again, this is no knock to you, Les. I really appreciate you. I look at you as a consumer. But generally, not all the time, but the people that want you to focus on payment are just salesmen. If you look at car dealerships, used car dealerships, all they want you to do is to look at the payment because they fudge the principal balance, or rather, the price. The price doesn't change. Your payment can. Remember that. So in my eyes, being 22 years in this industry, price is all that matters. If we want to compare the two, obviously payment matters. I'm not saying it doesn't matter, but I'm just saying my counter to that is well, being an expert and losing everything and then getting it back, price is what matters. Because I would rather have a higher payment and 50% of equity than a lower payment and no equity. Because if I have 50% in equity and a higher payment, I could sell my house and cash in 50%. That's my premise there, brother. That's my premise there. But I pulled your comment up because I respect you. All right, so we got something from Top Villain. This guy's scary. Hopefully he's on our side. I do not want to be going against you, brother. But can you negotiate the price? Yes. So it hurts me that you would ask that question. It hurts me because it means that consumers don't know what they should know. Everything, and I mean everything in real estate is negotiable. Don't forget that, brother, okay? It's really important. I got another comment from Les here. Housing market will be a mess for many years to come. Absolutely bonkers. I agree. And the question is as far the housing market is going to be a mess for years. So then the question is our values, while it's a mess, our values going to be going down overall, or are they going to be going up? You guys already know what I think, but I agree. All right, so I got one more from Vegas. Have a debt-fueled economy. In order for that to function, the consumer must have the ability to repay the debt taken on. Consumers are broke. People on the bottom are broke. Anyone that's living paycheck to paycheck is broke, man. I mean, if you're living paycheck to paycheck, they say 70% of consumers living paycheck to paycheck. If you can't pay your bills, it's not going to work. Let's see here. I wasn't able to make it to Delaware. I am so sorry. When I do these road trips, man, it takes so much out of my soul. I start to get unbalanced, start to miss my family. We didn't have time to go to Delaware. I'm really sorry about that, brother. Really, really sorry. All right, let's see here. That's funny. All right. Let's see here. I think that's it for the questions, guys. I think I answered all of your questions here. And other than that, whoa. Be auction. I don't know. That's out. What Super Bowl team? Not going to do it. Not going to do that. My grandpa told me never to talk religion, politics, and then I add sports in that mix. It's just people just start to freak, man. Anyways, guys, really appreciate you. I'm going to get out of here. Happy Friday. You guys have a great weekend. Don't forget, if you're stressed, if you have resentment, if you're bitter because, dang it, I wish I would have bought a house in 2020. Wish I would have bought a house in 2021. You guys, get out of your heads. Empower yourself. Start loving people. You guys, and by the way, I'm really trying to love everyone in the comment section. I'm trying to tone down. I'm sorry for some of the conversations I have in the comment section, you guys. It just hits me differently when I feel like someone's bullying someone. I just get involved, and I got to stop doing that. Please don't hold that against me. I love you guys. I will see you Monday. Come back Monday morning to start the week. We're going to do a market analysis. I hope you guys are equipped. Don't forget about my free home buying course, credit, income, assets, wedge, cash flow. Christy, thank you. All of that type of stuff. Have a fantastic weekend, Les. And honestly, brother, I just want you to know, me and Les kind of went back and forth. I was a little hard on him. Les, someone commented like, Travis, I was about to love you, but I see you beating up consumers. What they don't understand, Les, is I care about you. And sometimes, in my opinion, people need tough love. And that's why I called you out a little bit. That's the only reason, man. But look it, I love you, man. I mean, I really do. This is hard. This is hard to figure out what's going to happen next. It is so hard. I love you guys. Love you guys. Love you, love you, love you. And other than that, if you guys are out there investing in real estate, you guys know, I wish you luck and I hope you win.